So gold's been hitting all-time highs, right? But what if I told you one of the world's biggest banks is predicting a massive crash right after a huge surge? This forecast isn't just contradictory, it might fundamentally misunderstand the new rules of money. Today we're going to decode this forecast anomaly, and it could seriously change how you see the entire global economy. Okay, so a major Wall Street bank has put out this forecast that just seems to be at war with itself. They're calling for a massive, record-breaking surge for gold, immediately followed by a dramatic crash. So what's the deal? Is this just some short-term market noise, or are we witnessing a permanent structural change in how gold is even valued? The answer has some pretty profound implications.
And here's where it gets really interesting. JPMorgan is projecting gold could shoot up to $6,300 by 2026, only to fall all the way back to $4,500 in the long term. I mean, this is not your typical forecast where the price just climbs steadily over time. So what on earth are they seeing that leads to such a completely counterintuitive prediction? To really understand this forecast, we've got to look beyond the headlines and dig into the hard data. Because the numbers, well, they reveal a powerful and largely unseen force that's driving gold prices to these new heights.
You know, the truth is often hiding right there in the numbers. And in this case, the numbers point to a seismic shift in the global money supply. It's really the first big piece of our puzzle.
Let's just look at this timeline for a second. Before 2020, the U.S. money supply was sitting at about $15 trillion. Today, it's around $22 trillion. That is a staggering 47% expansion in just a few years. All new dollars basically created out of thin air.
And while all that money was being created, U.S. national debt was exploding. It's now approaching an almost unimaginable $38 trillion. This chart here shows you the direct consequence of all that debt. The interest payments alone, they've tripled in just 5 years. We're now spending about $1 trillion a year just to service our existing debt. $1 trillion a year! Now, it is absolutely crucial to understand this is not an accident. It's a deliberate policy choice. When you increase the money supply by almost 50%, you are systematically devaluing every single dollar in existence. This is how governments manage massive debt, but it really comes at a cost to savers and, well, anyone holding cash. But a devaluing dollar, that's only part of the equation. What's really worth noting is who is buying gold in this kind of environment. And the answer? Well, it reveals a major shift in the global financial landscape.
Now, if you're thinking this record rally is being driven by average investors getting swept up in some kind of frenzy, you'd actually be mistaken. All of this has happened without a strong retail buying mania at all.
The real heavyweight buyers here are central banks. Since 2022, they've been scooping up about 1/3 of all the gold mined globally each year. This isn't just a trend. It's a huge structural shift in demand that's creating a long-term floor for gold prices.
And they're not just speculating. This is a strategic move. As the world becomes more, multipolar, nations are reducing their reliance on the US dollar and moving towards a more neutral, time-tested asset, gold. And that has profound implications for the future of the entire global financial system.
Today, central banks hold roughly 17% of their global reserves in gold. That is the highest level we have seen in decades, and it shows a very clear trend of diversification away from U.S. Treasuries. By the way, if you're finding this explainer valuable, please go ahead and like, share, and subscribe. That way, you won't miss what's coming next.
So what does all of this mean for the future of gold prices? Are we just in some temporary, hype-driven bubble that's about to pop? Or is this a fundamental reevaluation of gold in a totally new economic era?
Look, this isn't a speculative bubble. It's a structural reevaluation. Think of it like this. A bubble is like a hot air balloon, right? It's inflated by hype and emotion, and it can pop at any moment. A structural revaluation, on the other hand, is like the ground itself is shifting, creating a new, higher foundation. This is being driven by the hard math of dollar debasement and a strategic policy shift by the world's most powerful financial institutions.
So let's get to the endgame and see how this new understanding completely changes our perspective on that bizarre forecast we started with.
This brings us all the way back to that forecast. That long-term prediction of $4,500, it's likely obsolete because it's based on a world that just doesn't exist anymore. Traditional forecasting models, they're just not equipped to handle these unprecedented levels of money printing and the fundamental shift we're seeing in global reserve currency dynamics. The shorter-term $6,300 forecast is a much more accurate reflection of this new reality.
And this quote, it perfectly captures the core difference. A retail frenzy is fleeting, right? It comes and goes. But policy shifts of this magnitude, these are generational. Multi-trillion-dollar debt and the strategic diversification of central banks are not trends that are going to reverse overnight. These are slow-moving, powerful forces that will continue to influence gold prices for years to come.
So the real question isn't whether gold is going to crash back to its old levels. The real question is whether our traditional understanding of money and value is becoming obsolete. As the world moves away from a dollar-centric system, what's going to be the new anchor of the global economy? And more importantly, what does that mean for your financial future?